this week, the Federal Reserve, the US Central Bank, is expected to lower interest rates as it grapples with low inflation and an economy that's starting to slow. But they're not the only ones. Wherever you look, central banks are pursuing easing policies. But does it make much difference when interest rates are already so low? We look at Japan, for example, as we ask on this week's Debunking Economics podcast, has monetary policy had its day? Now, central banks everywhere have interest rates at or near all-time lows. Let's look at the European Central Bank as an example, because they've just met. They decided not to change their interest rates. They probably will next time, but they haven't done it yet, even though they're concerned that Germany, amongst others, might be heading into a recession. Almost certainly are. We know manufacturing production is way down across Europe. But the ECB deposit facility rate, that's the interest they pay for holding money with their bank overnight, is minus 0.4%. So a high street bank pays the ECB to take their money, and it's been that way for 5 years. But the main refinancing operations rate, the MRO as it's called, is zero. This is how much banks pay when they borrow money from the ECB for a week or more. They pay nothing, provided they have the collateral. So, Steve, how can they go any lower when the ECB is actually paying the banks to borrow money from them? And we've got negative interest rates. That's happening in a few places, like Japan, for example. For the last 3 years, you have to go back to 2010 before you see them at the dizzying heights of 0.1%. How long is this going to go on for?
Indefinitely. I think I'd give it something, barring, of course, what I expect was this ecological crisis, a severe one, which will force us to completely forget about monetary constraints and go hell for leather to try to survive, help civilization survive. Until that happens, we'll have interest rates at zero, or in the central banks are trying to push it lower because, according to their economic models, that's the only way they can actually boost spending. Yeah. They enable to force negative rates on the public, not just on the banks, and with that, stimulate the economy. And I think
that's a nonsense, isn't it? That whole idea. I mean, if it's zero, or banks are, I guess the difference between not charging a bank and actually paying them to take your money, if they don't need it, they won't get it, will they? I mean, that surely is why we can look at monetary policy and say it's reached a dead end. I mean, the Taylor rule is obsolete.
Oh yeah, I mean it's. And that's the important way to frame this whole thing, because central banks have in their minds an equilibrium model of how the economy operates. And that equilibrium model, and I know I keep on emphasizing it, but I've got no bloody choice but to, that equilibrium model excludes the role of money, banks and debt, money, banks and credit completely. So that the real world where these things actually happen is what they're trying to manage with those policies. And their magic numbers have always been, and they look at the DSGE models, and the Taylor rule is part of this, is that they believe there should be a 2% rate of inflation, a 3% rate of economic growth, real economic growth, and a 4% rate of interest. Those are pretty much hardwired into their models, and they very reluctantly change them when they find things don't work out as they expect for some significant period. But that's their yellow brick road. That's where it leads to, those numbers 2, 3, 4. And what they're finding is they always expect to have to be pushing the rate of inflation down towards 2%. They thought they'd be having excess wage demands or raw material prices rising, and they'd have to find ways to retard demand so that the price level would fall towards the 2% target. Of course, they didn't see the financial crisis coming, hit them like a brick, and I know that from speaking to some of the modelers, particularly in the Bank of England, but others, they're completely blindsided by the crisis. They were partying about how great their management was one day and saying, what the F was that the next? They still haven't revised the models to include the role of credit. But now the one thing that I find, this will be a bit of the bend your mind part of the podcast, that there is a tendency when you include credit in the system, there is a tendency for rising debt to get falling inflation heading towards a negative, and that's the situation they're in. And now they're trying to boost demand by actually turning interest rates negative for depositors. Right,
give me that again. So we've got rising debt. So inflation falls because, well, I guess, explain why that's happening. I guess if we've got more debt, we don't want to spend as much, so that keeps prices subdued.
This is the mind-bending part of it, because one thing which came out of my very, very simple model of Minsky's financial instability hypothesis Gee, I said that without actually falling over my own tongue. Was an unexpected outcome, that the increasing level of private debt was actually paid for by a lower workers' wage share of GDP. So I had a model in which the only borrowing was being done by firms. The firms were using that money to build factories. They were not doing Ponzi speculation. And if there was a low level of capitalist desire to invest, then you would slowly converge towards an equilibrium. In the hunky-dory situation, a constant low level of private debt, a constant wages share of GDP, and a constant employment rate. So there's a stable equilibrium in there.
The utopian vision.
Utopian vision. Now, when I amped up the desire to invest, which of course is a positive thing, you want capitalists to want to invest. This is a capitalist system. It is one because they invest and innovate, and you want this to happen. When I ramped up the investment rate, two weird phenomena started to happen. The first was that there was a period of diminishing cycles in employment, and what I was using at the time, a proxy for inflation, also diminishing cycles in the cause of inflation, which in the model ended up being the wages share of GDP. And then the fluctuations would, and in the background, what you had was a rising level of debt. As the rising level of debt got more extreme, those diminishing fluctuations turned into amplified ones. So a period of diminishing cycles gave it a period of rising cycles, and ultimately a breakdown when the level of debt reached a level that the capitalists who were paying the interest bill on that debt didn't have enough of the share of income to finance it. And the reason that's failed is because the workers' share of rate of change of GDP couldn't fall as fast as the bankers' share was rising. And in the middle of all this, before you reach that crisis point, the firm share, the capitalist share of income, was fluctuating around a constant level. So the capitalists, from their point of view, everything was stable in the sense it was cyclical, but cyclical around a horizontal constant trend in their income share. What was going down was wages share of GDP as the bankers' share went up. And that is it's called an emergent property of a complex system. That it
is complex. So let's get at the risk of asking you to repeat yourself. Let's go through that step by step. So we get to the stage where capitalists want to invest. So what's the repercussion? Take me step by step by that,
okay.
So I can keep up.
For members of the Patreon audience listening to this, if you go to the download page I put on profstevekeen.com/Patreon, I explain this verbally in the Can We Avoid Another Financial Crisis?
Yeah.
You'll find the electronic version there. And so what goes on with you, you start from an initial position where I can start from, say, zero debt, which is where I start the model from for simplicity's sake. So zero debt. And
just as Steve starts to explain in detail for the second time, I have to tell you, this is where we leave this free version of this podcast. If you want to hear it in full, and there's 35 minutes of discussion about central bank monetary policy, then you need to subscribe at debunkingeconomics.com or become a supporter of Steve Keen on Patreon. Go to patreon.com/Prof Steve Keen. If you pledge $10 or more support to his work, then you'll get access to this and all the other podcasts in this series. Hopefully you'll do that, and we'll see you back here again very soon. Thanks for listening.